Hello, everyone. This is Alexandra, General Counsel at Bricken. Some of you already know me, but with me today I have Tyler. Okay. First of all, I'm going to introduce a little bit why is this webinar happening or what is its main objective. Okay, and also I will introduce myself because well, almost all of you know who I am, but to understand why is this webinar happening. Okay, as you know, I'm the General Counsel of the company, which means I provide feedback to the internal departments of the company. But of course, we have clients and they need also some guidance in the legal topics. For that reason, we work with partners, and some of them are legal partners like Tyler. And for that reason, he's today with us in order to explain a little bit what he does and how he helps clients. Okay. Thank you, Tyler, for being with us. And I would like if you could do a little bit of introduction of yourself and also about your law firm in order we know a little bit more about you.
Sure. Thank you very much, Alessandra. It's very nice to be here, and thank you for having me. As Alessandra mentioned, my name is Tyler Hartraft. I'm an attorney in the United States. I'm a partner at a boutique law firm called Bull Blockchain Law, where we advise founders, companies, asset managers, and investors regarding blockchain and Web3. Since 2018, we've been around advising on corporate and regulatory matters related to blockchain and Web3, including SEC regulations, CFTC regulations, money transmitter laws, and investment advisor and fund regulations. So we work with a variety of companies and clients on matters related to tokenization, NFTs, asset issuance, and tokenizing real world assets, among others. And so very happy to be here today discussing tokenization. I know there's a lot of questions out there, and hopefully we can answer some and get into some good questions at the end of the presentation.
Thank you, Tyler. Tyler prepared a presentation in order we can understand a little bit the concepts of tokenization in US, okay? And afterwards, we are going to do some questions in order to understand more from a practical point of view, okay? If you want, Tyler, you can start your presentation.
Perfect. All right. So all of you are here. I'm sure you're very familiar with tokenization, but I always like to level set at the outset of these conversations just to make sure we're not talking past each other. And I think it helps understand some of the use cases that we're going to be discussing later on in the presentation. And so actually defining tokenization, understanding what about it is important really helps with understanding why the use cases are pretty exciting and what's being done to really make the financial system more efficient, transparent, and really workable for everybody, hopefully. So when we're talking about tokenization, you can define it simply as the process of representing rights digitally and on a programmable platform. I really like that definition because I think it's very succinct and it really hits the major points embedded in tokenization. And so when we talk about what actually when we unpack that a little bit and talk about what makes tokenization distinct, there's a few things, and a lot of what people talk about commonly are fractionalization, digitization, and democratization. And I think the first two, fractionalization, well, we kind of have that already. Like we have stocks and shares of stock in a corporation. We have LLC units in an LLC, and we can pretty much fractionalize any kind of asset by creating a company that owns that asset and then issuing interest in that company. So I think the fractionalization piece isn't necessarily the most important piece. It is important and it's helpful that we're doing it in a different way. But I think if you stop at fractionalization, you're missing a big part of the picture. And I think that goes for digitization as well. We did digitalize a lot of rights, and we're not using paper anymore to a great extent. But the way that we're digitizing and using distributed ledger technology, I think, is the important component. And then the last one I mentioned was democratization. And I think this is maybe a little bit of a misnomer or kind of a misapplied concept, because at least in the US, when we talk about tokenizing an asset or an investment or some right, really, we're still typically dealing with the US securities laws. And so when we're dealing with those laws, those don't change because we've now tokenized. And that doesn't make it easier to be more inclusive to different groups of people. We still are largely dealing with certain levels of high net worth individuals who can only invest in different types of assets. We'll walk through some examples of cases where instances where that's not the case, and you can include retail investors. But I think waving the democratization flag isn't really always that helpful when we're talking about the benefits of tokenization. And where I think the real power is in the shared ledger, the programmability, and the composability of these assets. And so a lot of these assets that we're going to be looking at and the use cases that we're going to be talking about, we're talking about really what are permissioned assets that are trading on public chains. And so that shared unified ledger really reduces reliance on separate systems for ownership records, for transaction settlements, and it really just makes things more seamless and automated across different data sets and different groups of people. The programmability aspect of it, so these assets can be governed by smart contracts. We can execute transactions based on predefined rules, and this really enhances the speed and accuracy of transactions. And so, thank you, Alex. Sorry, I didn't switch the slide. But programmability really enhances the speed of transactions and the accuracy of transactions. And so that's another, I think, key pillar of tokenization. And the last one being composability. So if you kind of think of these as, these assets or smart contracts as Lego bricks that can fit together and work on top of each other, that's what the financial system, at least in the US, currently does. I mean, you have derivatives instruments that are based on other underlying assets, and you have contracts that are based on other contracts. And so really having financial products that can be shared, information can be and data can be shared across a distributed ledger, and then transactions programmed based on predetermined rules, really enables new forms of structured and bespoke instruments. And so that's kind of, I think a really important points about what we're dealing with when we're talking about tokenization and why. And I think it gets to a lot of the why for tokenization. Why are people so excited about tokenizing? I see tokenize this, tokenize that in the news, and it sounds cool, but what does it really all mean? And so I always like to start out with just a discussion on what are we actually talking about here. But next we can dive into some examples of trends in tokenization. And if we start to look at different trends, we look at what is actually being tokenized, right? These concepts sound really cool, but how do we use tokenization for our benefit, and how are people actually using it in real life? And so we get to some of these case studies that I've listed here. The broad categories, we're looking at tokenized deposits, tokenized securities funds, and equity and tokenized stock experiments. And so there's a few use cases in each of these different categories where we can see what's being tokenized and really start to understand kind of why it's so exciting and really kind of the magnitude of what's being tokenized, with Wall Street moving towards increasingly embracing tokenization in the US. And I think it gets to, when you start to understand how it's being used, you start to understand, why it might be important to tokenize certain assets or think about tokenizing certain private assets. Because if these systems and investments are going to be interconnected and interoperable, then there could be real tangible benefits to tokenizing private private investments or private stock issuances early on, or at least being ready for that to happen, so that you can interact with your company and your investments can interact with the broader financial system in the U.S. If you are interested in the U.S. market, which I assume most people are here for that. So if we look at tokenized deposits, what are we talking about here? So Custodia Bank and JP Morgan have two examples of this. Really, Custodia launched the first ever tokenization of a US bank's demand deposits on a permissionless blockchain. What does that mean, right? So the purpose is to represent the US dollar deposits on hand at the bank with tokens that are issued on a public blockchain. And so with JP Morgan, they did this for institutional deposits. They use the Base network, which is a public Ethereum layer 2 blockchain, and they made it permission. So not anyone can go and use this. You have to be a JP Morgan institutional client. But essentially, what happens is they fully back the deposits one-to-one with JP Morgan, the coins one-to-one with JP Morgan deposits. And then there's the ability to kind of use these tokens and send them to people who are all whitelisted by JP Morgan, who are also institutional JP Morgan clients. The benefits are 24/7 settlement. The transaction fees are near minimal. And so this is bringing speed and flexibility into the system of private banking, at least for the JP Morgan deposit token, and same for Custodia. If we look at tokenized funds, so all these names are pretty familiar. We see institutions, like I said, increasingly embracing tokenization. So you have BlackRock's Biddle Fund, which is, I just checked this morning, it's north of $2.8 billion that are tokenized in that fund. It invests in U.S. Treasuries, and it's launched on several blockchains. So investors in that fund can access U.S. Treasuries with all the tangible benefits of 24/7 trading and settlement and reduced transaction costs. Tokenized stock is really kind of a hot topic right now. I think the U.S. isn't necessarily, these aren't available in the U.S., but there are multiple companies that are looking at launching these or have launched these in other markets. And so really, it's sort of a derivative instrument that tracks the equity of an underlying stock. So OpenAI, SpaceX, you can read the tweets from Sam Altman about this and how warning the investors that they're not actual equity. They don't represent actual equity in OpenAI, which I think most people understand, but it can be a little bit confusing if you're new to the space. And so this is an area where even the SEC, the head of the SEC in the U.S. has commented favorably and said tokenizing stock has a lot of potential for innovation in the U.S. And so there's speculation also that Coinbase has or will seek a no action letter from the SEC or some sort of relief from the SEC to offer tokenized stock on its platform. I'm not breaking any news here. I don't have any inside information. It's just, if you're reading, kind of trying to read the tea leaves a little bit, they're very excited. And the head counsel over at Coinbase has said this is a priority initiative for them lately, especially while we have an SEC that is very friendly towards crypto and very interested in advancing favorable crypto policy. All right, so those were a couple use cases. Jumping to U.S. market opportunities for tokenization. So why the U.S. market? Despite some turmoil from the latest administration, I think to put it lightly, the U.S. is still largest capital markets with more than 50 trillion in investable assets. There's a lot of institutional appetite for digital infrastructure investment. We have a lot of regulated players who are coming into the space, custodians, ATS platforms, developers, and we now have a very friendly regulatory environment for crypto. So I just recently did a talk on what is happening at the SEC, who's in charge, what are their priorities. To give a little bit of insight, there's been numerous roundtables with the SEC and a lot of talking going on to make sure they fully understand what the issues are and to lay out their priorities. Those priorities and those conversations have been around. One of them specifically tokenization. So they did a whole roundtable on tokenization. They did a whole roundtable on DeFi, and then they did a whole roundtable on token issuance. And there was one or two other roundtables. And so these have all happened over the course of the past couple months. And just to give you a little background on what's happening from a legislative standpoint, it looks increasingly likely that the U.S. is going to pass stablecoin legislation in a matter of maybe a month, maybe sooner than that. And so we're in a very favorable regulatory environment in the U.S. That has not traditionally been the case. And so a lot of people, I think probably on this call even, are looking at the U.S. market and saying, maybe it's time for me to start paying attention and understand exactly how I can gain access to that market and what I can do to position my company or my investment thesis around including the U.S. market. So we'll talk a little bit about what that looks like when you're trying to enter the U.S. market. These are, I'll go over token classifications. These are not fixed. There's all kinds of creative ideas out there about how to structure rights around a token. But the token classification options, what we typically see are equity tokens. So a tokenized stock, a tokenized interest in an LLC or a limited partnership. We've tokenized limited partnership investment funds for asset managers previously. We've also tokenized, single asset SPVs for commercial real estate properties, for large scale residential properties. And so, that's typically what we see is tokenizing equity. We also see a lot of interest in tokenizing debt. It depends on kind of the current market and where interest rates are, but debt has been traditionally a very hot market as well. Hybrid tokens, we don't see a lot of this, and this is kind of a flexible term to refer to anything that's not in the prior two categories. I would even say, if we're talking about something with a utility component, just a traditional token, we're not talking about something that is necessarily a security, but that does require some more complex analysis and understanding. There's a lot of DeFi products out there now that are looking to marry with TradFi products. So if you look at products that are offered by companies like Maple, there's opportunities to bring people, usually high net worth or institutional investors, into DeFi protocols that are focused on lending to highly vetted institutional borrowers for attractive yield rates, and how that can kind of be done in a really efficient way using DeFi, and then marrying it with TradFi opportunities is something that's currently being explored. And I think the LP tokens or liquidity provider tokens that are part of that system would likely fall under this kind of hybrid token model. So those are things that we deal with for token issuers. We're not just on the side of doing securities offerings. So if you have questions about a creative idea for a token that might not necessarily fit within the first two buckets, always happy to have a conversation and strategize around what that would look like in the US regulatory framework. But if we are talking about one of the first two tokens, there's a very clear path to offering those. Those are securities. The token is a technology overlay. It's a representation of the underlying rights, which are debt or equity. And you do that you offer those instruments to US investors through typically one of these exemptions. There's a few others, but these are the most common, and I'd say Regulation D is the most common of all the ones on this page. And so Regulation D allows you to offer. There's two flavors of it, but the primary one we see is the Regulation D offering, where you offer to accredited investors only, and that allows you to generally solicit or advertise your offering broadly. Accredited investors are people with a net worth of $1 million or more, excluding primary residence, or they have an annual income of $200,000 for the last couple of years. There's also been recently an amendment to that accredited investor definition now includes people with certain financial licenses. So, your investment advisors with certain licenses will qualify as well. Which makes sense because they're advising people on financial regulation. They should qualify to make an investment in a private offering. Regulation S, I think there's probably going to be a lot of interest in that. That is the offering exemption that is used to offer to non-US investors. So if you have a US based company and you're offering to people who are offshore, then this is the exemption you would be utilizing. There's very minimal requirements as far as what is necessarily required for a Reg S offering. There are limitations on when you can and cannot resell that offering. The primary rules around Reg S are to prevent flow back of that offering to US investors. So the SEC doesn't want you going out and selling an investment to a non-US investor, and then 5 days later they sell it to a US person, and now you've just done an end around the US securities laws. Can't do that. So there are some resale restrictions there to be cognizant of, and we work through our issuers on how to structure often those combined offerings where you're offering to US investors under Reg D and to non-US investors under Reg S. Regulation A, that's an offering where you can conduct what's essentially a mini public offering, and you can offer to retail investors up to 75 million annually. There's more entailed there to do a Reg A offering. You have to get your offering prospectus approved by the SEC. So typically you prepare that offering documentation and then you submit it to the SEC, and then there's a comment period where you go back and forth on edits before it gets approved and submitted to publicly for investors to review. Regulation CF is the crowdfunding exemption, and really what that allows is you to offer to retail investors and raise up to 5 million. It's not as burdensome as far as what's required under Regulation A, and one of those requirements is that you only submit your prospectus to the SEC. They don't have to sign off on it. But an additional requirement is that you have to work with a crowdfunding portal. So sometimes we get clients who come to us and say, I want to be a platform for Reg CF offerings. Well, that's a whole regulated business in and of itself, where you have to become a broker or a funding portal approved by the SEC. Sometimes we get clients who come to us and say, well, I want to do a Reg CF offering, and I want to offer it on my website and market it. Well, you can't necessarily do all of that. The investors have to subscribe through a funding portal. And so, unlike Reg A, where the SEC doesn't approve the prospectus, that gatekeeping is done by the portals themselves, because the portals don't want to lose their licenses. They're going to make sure that you're using their forms and complying with a lot of the rules and regulations, and it's going to be reviewed by their attorneys. And so these are the 3 or 4 primary offering routes that we are advising clients on very regularly about how to access the U.S. market, and if there's offshore interest, the non-U.S. market as well. Of course, if you're offering through Reg S to non-U.S. investors, you also have to comply with regulations in the jurisdiction in which you're offering. So that doesn't give you, carte blanche to Reg S doesn't give you carte blanche approval to go offer anywhere you want without observing those rules and regulations. So if we're dealing with, investors in South Korea or Europe, we typically work with local counsel in those areas to make sure that the offering is compliant in those jurisdictions. So another big area is tax considerations for foreign managers and issuers. And so we see this a lot with the real estate investments. The way the tax laws are written, it's disadvantageous for U.S. investors and non-U.S. investors often to be investing in the same vehicle. Someone's going to get, a more adverse consequence, whether it's a U.S. investor going into a Cayman company or BVI company, or it's a non-U.S. investor going directly into a U.S. company. So that typically necessitates what's next to number 2, blocker entity strategies. So structuring your investment offering and your company to be compliant, not compliant, just to be tax efficient, really, to mitigate direct tax exposure is really important. Even when we're tokenizing, it doesn't do away with the necessity of dealing with the tax laws and making sure that these rules are observed so you don't create unexpected tax burden for your investors. So to discuss some of the tokenization sectors, I think these are really interesting areas where we see tokenization being utilized. I'd say by far the biggest area of interest that we see on a day-to-day basis is real estate, whether it's commercial or large-scale residential projects. We see a lot. We get a lot of clients who are very interested in tokenizing funds that are investing in real estate, and we've tokenized numerous funds investing in real estate. Tokenized treasuries is a really big one as well. We mentioned BlackRock's Biddle Fund, so if you're interested in reading more about that, there's plenty of fodder out there. Franklin Templeton also, they were really the first to do what BlackRock did. BlackRock has now surpassed them with AUM, but Franklin Templeton was really a leader there in starting a U.S. Treasuries, tokenized U.S. Treasuries fund. Carbon assets, we do get inquiries about this as well. It's not very frequent, but it's an interesting area. There's some gray area as far as the regulatory impact with some of these assets. And so I think this is an area where that's going to continue to evolve, maybe less so in the US now under the current administration, which is prioritizing environmental ESG severely less than the prior administration. But we'll see how that evolves. And then private credit. Private credit market has been expanding drastically over the past numerous years. We've gone from a system where bank credit was really largely the end all, not the end all be all, but it was definitely the leader. Now, since the financial crisis back in 2008, private credit has really expanded, and we're seeing a lot of interest institutionally in tokenizing private credit, and so that's an area that's highly has a lot of potential for tokenization as well. So just to get to some of the more nuts and bolts and some practical takeaways for everyone, what does the process look like when you're trying to tokenize and you're doing that in the US market? So typically your first step is to start vetting and interviewing and engaging with your service provider. So your legal advisors, your tax advisors, your tokenization platform. If you're a fund, sometimes you'll have a fund administrator as well, an accounting firm as well. Sometimes that's all rolled up into tax. And sometimes the fund admin is rolled into your tokenization platform. So there can be some overlap here with your different service providers, but really you want to start selecting your team and understanding core things about how your offering is going to work, where you're going to be launching the offering, and get those service providers in place. And then really the next step is, I'll speak to the legal side at least, structuring the initial offering preparation and documentation. So establishing and kind of frameworking the company structure and the launch, figuring out which securities exemptions you're going to use, where's our investor base. Those questions often go hand in hand. So if I want to access U.S. and non-U.S. investors, well, where am I targeting? Because we got to look at those jurisdictions as well for compliance. And where do I think most of my investors are going to go? Do I want to spend a lot of time and money planning for non-U.S. investors when I may only get one or two? Because it's not an insignificant expense to set up a separate company in a tax-neutral jurisdiction, do a separate PPM for those investors and subscription agreement. But those are all the things that we work with our clients on in the very early stages of an engagement to understand the full scope of the offering, the expected investor base, and what regulatory compliance is going to be needed for the offering. But regardless of that, every offering is going to require a private placement memorandum, or under Regulation D, you don't need one, but it is a best practice for liability protection purposes. In the US, if you make a material misstatement or omission, then that is a strict liability offense as far as the SEC is concerned. And so some of the damage that can be done is that investor can have a claim to claw back their entire investment, regardless of whether the fund is successful or the asset is successful. So if it's not having a great year and there's liability attached for any particular investor, and that investor invested $100,000, but maybe their portion's only worth 50, company's still on the hook for that full investment to refund it. And so that's why it's really important to do, even though Regulation D doesn't require it. That's why you see most of the time there will be a private placement memorandum in place, because it limits the liability for any kind of statements in emails, statements on in advertisements and publications and on Twitter or X. Those things investors can claim, and the SEC has even done this for token issuers, not in the securities context, but for token issuers that they want to argue the tokens are securities. Look at this Twitter post from 3 years ago when you were launching the product. That gives an investor an expectation of profits. Those are things that you can limit by doing a private placement memorandum, because that memorandum is going to say this is the sole universe of the statements that matter, and no one else is authorized to make statements on behalf of the company about the asset. So regardless of really what jurisdiction you're targeting, or regardless of whether you're including non-U.S. investors or not, it's very important from a U.S. perspective to do that documentation, and that's what we primary time of our engagement is spent on a lot of times. Launching the offering, so that means you've got all your documentation done. You're onboarded with your tokenization platform, like Bricken here, and you're ready to launch the offering, have great success, get all your investors in the door. Typically, what happens next is secondary trading, but there's often a kind of a cooling off period there where the securities, at least for U.S. investors, are not sold for 12 months. There's shorter time period for non-U.S. investors to resell to each other. But generally, when we're talking about U.S. investors, if we're talking about a Reg D offering, it's going to be a lockup period of 12 months before those investors can resell. And at that point, typically 9 months into the offering, we're re-engaged and we start helping with certain documentation to list on the platform. One of those pieces of documentation is really disclosure statements. So updating your PPM with any material changes that have happened over the course of the past 9 months, so that new investors who are going to be buying on the secondary market can look at that information and make an informed investment decision before they purchase your securities. And that is an overview of tokenization, US market, the process of tokenizing. I think we have some questions lined up and some questions in the comment section. So I
Yeah.
started to
Let's.
let Alessandra take a little bit, and I'm happy to jump into questions.
Yes, we have some questions from the audience, but maybe let's start with some questions that I have, okay, from the presentation. You were showing, no, these points that a person or a company that wants to issue a tokenization must follow, no, a higher service provider, then, well, of course, all the steps. But I want to put like a zero step, okay? Because sometimes, and I hate these questions when clients do, no, it's like, what is the best jurisdiction for me? When a
Mhm.
client comes and does that question, is really difficult to answer because, of course, you have to bear in mind your asset that you have underlying, no, that you were explaining, no, the share ones, the mixed ones. Also, you have to know where are you based. No, you were saying, no, about the cross jurisdictional issues. No, if you want to issue maybe the US, you have to bear in mind the European laws or vice versa. No, and for that reason, I'm doing the bad cop now with you, Tyler. I'm being the client, and I am asking, okay, if we are in this zero step, when a client knows the asset that has maybe already a company abroad, like not in the US, but maybe in Europe, in Spain, for instance, what do you think is or will be attractive for that company to understand from the US to be able to issue from there? Okay, and if there is a specific asset, like the underlying asset that you would recommend, US is the best fit for you, or I think it's very good for you, or also the business, like real estate or I don't know, entertainment, and also the asset that was asking, like equity or another one. What do you think is your answer to a client that comes to the office and asks that?
Yeah, no, it's a common question, and I think it's something we usually hammer out in the first consultation call, whether that's a half hour, an hour, just talking through what the plans are, because it really is difficult to say universally one way or the other, even when we're talking about one asset, or there's multiple factors, as you mentioned, that go into the decision: where the founder's based, where are they going to be based, are they nomads? Sometimes we get that, right? And so accounting for that, accounting for the location of the expected investor base, accounting for the location of the assets. Those are all important questions. And so if we have a US founder with a US asset that wants to offer to US investors, we're not going to go form anywhere else. We're not going to subject ourselves to the jurisdiction of, Cayman or BVI or Europe or anywhere else. We're going to focus on the US. That's a very easy answer. Um, it gets more complicated when you have founders in different jurisdictions because they have all their own individual tax consequences as well. And so we have to sometimes, we can think from a US perspective and we can talk about, flag issues for those other founders, but often they're going to engage with local counsel to understand, hey, if we make this a US company like my partner wants to, what are the implications for me from a tax perspective? And is there a better way for me to structure my ownership interest? Like maybe I want to invest in a holding company in a tax neutral jurisdiction. Maybe I don't because the tax treaty that we have with Cayman or BVI in my jurisdiction is not favorable. And so it's going to hurt me more to do that. And so those are all important questions that really require a lot of thought at the outset. And a lot of times what we're doing is trying to put the brakes on a little bit because this industry moves faster, I think, than any other industry, from zero to the next step, or at least wants to. And so, trying to impart the knowledge about why this is such an important conversation at the outset, because you can't undo the tax consequence, and we'll get those questions too. And it's like, well, I can't put the proverbial toothpaste back in the tube because the tax consequence already happened. And so having those conversations early and really thinking about them is incredibly important. And we always appreciate that everyone in this industry wants to move really fast. They have great ideas. They don't want to miss the market. You can do yourself a big favor if you are successful. That planning in the beginning is really important.
Thank you, Tyler. All clear. And what do you feel like? There is a lot of interest from companies abroad to come to US?
We're seeing that. Yeah, there's been a lot of companies on the sidelines that just had no interest in dealing with the U.S. from a regulatory perspective. I think if you are, that's more so on that hybrid token side where we're talking about something that is not necessarily going to be considered a security, or there's a good argument that it shouldn't be considered a security. Although the SEC in past has been so aggressive that there's a lot of companies that did not want to take that chance.
Yeah.
They did not want that battle, and they may not have had the funding for that battle. Let's be honest;
Yeah.
it's really expensive to litigate. I think companies that are in the, probably more interested in offering on a platform like Bricken, there's a very clear path for them, and there always has been. Tokenization of securities has not been the ire of the SEC. It's not something that is a regulatory gray area. So I think there's probably concern born out of, or hesitation born out of, just general fear about the SEC as a whole. But that shouldn't be the case really for issuers of securities who, they should feel comfortable. They should have felt comfortable previously, but I can understand why the SEC made them feel uncomfortable, even though there was a regulated path forward, and they certainly should feel comfortable now.
Nice, thank you, Tyler. Related to this, no, you were talking about the SEC and the mindset of institutional approach of tokenization, no, that they want to talk more about it, they are more open it. You are already telling us, no, that companies from abroad also are interested in coming to the US, no, and also you were talking, no, about how the SEC may, or the fear that these companies has, no, that the SEC requalifies into a security, no, these issuance. No? What is that you would recommend in general terms? Because of course there is no real case that we can take now in this webinar, but in general terms, what are your recommendations in order to avoid a requalification to a security? Or if we decide to issue a security, you before were explaining, no, that we have these exemptions about Reg D, Reg S, no, a little bit how we have to do it in a proper manner, or what we have to have in mind when we are trying to do this avoidance of requalification, because we are not issuing a security, or a security that has some exemptions.
Yeah, sure. So if you're trying to, if you think you're going to be building an asset that the properties and characteristics of it are not in the realm of a security, or at least that you need to do that analysis. I think you need to do that analysis first, and then second, we really need to understand like how to structure that. And so there's a lot of different ways involving offshore entities, typically involving offshore entities, to structure those types of products, and we work through clients on that. But a lot of times, those are things that take a lot of time to build, and work through that analysis. At the end of the day, the SEC may disagree. I think we're in a much better position now than we were previously with the current SEC, and they're much more willing to actually work with you, maybe grant some exemptive relief, or at least hear you out, whereas the prior SEC was not. They were pretty much door open policy, but in reality, the door was shut. And so I think if you're building that, you need to get good advice early on and really map it out. If you are looking to issue a security that is, and you're looking to take one of the offering exemption routes, the general rule is the security must be registered. And what that means, absent an exemption, that means going public in some form or shape. And so really, exemptions are the path forward. So whether it's Reg D, Reg S, Reg A, or Reg CF, those are the exemptions that are primarily used to offer securities in the U.S. to accredited and to non-accredited investors when we're in the case of Reg A and Reg CF. And so working through those exemptions, the requirements of those exemptions, they won't work for all companies. Like Reg CF and Reg A can't be used by investment companies, which are essentially funds investing in other securities. They will work for companies investing in real estate generally, but they won't work for strictly funds that are investing in other securities. And so working through the requirements of those exemptions, that's a lot of what we do in the early stages of an engagement with a client, just to understand, we got to understand the business model. We got to understand the underlying assets, because those are going to inform what exemption we choose to use. And so if we're talking about offering pursuant to a securities exemption, then that's something that we're going to deal with early on.
Super interesting. Yeah, I agree with you. Like, my recommendation from a European perspective will be the same. In fact, we have in the chat some comments. Okay, and one of them is basically a little bit about the intersection between US and Europe. Okay, Perfume Group is asking what is the equivalent of MICAR, okay, in the US. Like, it's very difficult to answer this question, Tyler. I think from at least for what I believe, what all you explain. But I give you the floor, and let us know, what do you think.
Yeah, I think we don't necessarily have an equivalent, right? We've got a lot of questions over here. They're hopefully going to be answered this year and next year. At least this year, we're working on stablecoin legislation, and I mentioned earlier, I think that's going to be a matter of weeks, maybe a month, before that gets approved. The Genius Act, it's called in the U.S., is going to regulate stablecoin issuers, and so the president has just recently said that he wants that passed through the House of Representatives as soon as possible. It's already been through the Senate, so that's on the docket. There is a market structure bill that's being passed around and marked up that has a lot of, a good chance at some movement or approval this year, maybe the end of this year. But you never know what's going to happen in politics, and so you can't say for sure. But there's been a lot of hard work put into the idea of market structure for crypto, so dividing who's in control of different assets at different times. Is it the CFTC or the SEC? When does each get involved? What qualifies as decentralized? How do you issue a token? Those are all concepts that are in that market structure bill. And so that's the second big piece of legislation that we're expecting this year, hopefully. Outside of that, there's priorities on the regulatory front. So the SEC has different priorities for DeFi, for tokenization, for token issuance. And those are all things that, we might see some token issuance we're going to see in the market structure bill to an extent. But some of these other concepts, we're going to have to rely on the regulatory agencies. And just a quick primer on the U.S. legislative system and legal system, your best thing to bank on is legislation that's been passed. So the market structure bill, the Genius Act, if those get passed, that's great. they can't be easily undone by the next administration. Say it flips, and we have someone who's hostile to crypto. So that's why there's such an urgency right now. Your other relief is coming in the form of formal rulemaking, guidance, and just general no action relief in that order. So rulemaking is stronger than guidance, and guidance is stronger than no action relief, because no action relief only applies to the person that applied. Guidance applies to everybody, but that can be easily recalled by the next regulatory agency head in charge. And so really, that's why there's a lot of pressure right now in Washington, D.C. We work with policy groups that on a lot of different crypto policy items that are trying to get pushed forward, that are favorable to crypto, to Web3, to gaming companies. And so there's an urgency right now. And hopefully we'll be able to have an in-depth discussion soon about how some of these things compare once they get passed.
Yeah, and in fact, a question that I would like to ask, based on that, is what do you see tokenization in 2 years? And also, if you have some interesting use case that a client presented to you and how you have managed it, and etc. If you can give a little feedback on that, as we have 15 minutes. And
Yeah. I think we're going to continue to see. We haven't really seen the liquidity in the private markets for issuers yet, but I think we're going to continue now that institutions are involved and embracing it. The SEC is not hostile, and so people are taking it more seriously. I mean, you see BlackRock get involved. They say, "What? Okay, well, why are they doing that? What is this?" We have an administration that is fully supporting crypto in general, which bleeds into support for tokenization, and so I think we're going to continue to see growth from institutions, more institutions adopting it, more private issuers interested in it, and how can it work for them. And the area we get a lot of interest and always have is real estate tokenization, because you have a traditionally liquid asset, and just making that more liquid, more tradable, more accessible it's a great benefit. And if private issuers can put themselves into the system that's going the direction of tokenization, and then interact their assets with some opportunities that may be on the cutting edge, like lending in DeFi and lending with institutions. It's going to be, I think it's going to just continue to evolve, and we're going to see some exciting products coming out in the future. And then as far as use cases, I mean, I mentioned real estate a couple of times. I'll mention we've specifically, we've done some big real estate tokenization projects. I'm thinking of one in Texas that was a large scale residential living area. So that was where we tokenized. It was a $60 million project, and they tokenized the existing equity in the project for the investors. They had sold. It's an interesting use case because this was a company that hadn't tokenized initially. They had sold interest in the investment fund or investment company to investors, learned about tokenization, and said, "Hey, we think this is exciting. We'd like to tokenize our existing investors, and we think this is part of the future, and we're really excited about it." So we help them tokenize their already outstanding and issued equity interests in the vehicle that was invested in the property. Some things that you have to look out for when you're dealing with existing interest and real estate, lender approvals. So we had to go to the bank and explain what this was, because they got very nervous that this company was issuing a token, and it was at the height of all these bad things happening with FTX and things like that. So they got very spooked, and we had to have a very it ended up being a very good conversation, but we had to explain to them, this is not this company going out and selling a token to anybody. And so you have to get your lenders on board typically before you do something like this. And you just want to you might not have to according to the contract, but you want to be, you want to have that good relationship with your lender always. And so those are some things that, we had to work through with that client, and, they were able to proceed, and everything ended up working out well. So that was a specific project. We're currently working on a large scale real estate project, tokenization of equity. Those issuances, those equity interests have not been issued yet. So this is going to be a new offering done under Regulation A. They're going to
Okay.
be aiming to raise the full 75 million and then do follow-on offerings in the
Mhm.
future for other properties that they bring into the investment. So that's an exciting one that is keeping me busy right now.
I see there are a lot of Web2 companies, no, that are interested now in tokenization.
Yeah,
Yeah.
or even not even maybe Web two, just kind of traditional real estate managers or asset managers that are from all walks of life that are
Exploring.
hearing about it and getting interested and they want to get involved. Yeah.
Of course. Also, well, we are almost at the end, but we have a last question. If you can answer it, Tyler, from Michael. He says it's better to get moving now on a tokenization project before imminent legislation is passed, or should we wait? Related to
Yes.
your explanation
Yeah,
before.
good question. The legislation is not going to change tokenization from the perspective of private asset issuers. I guess it depends on exactly what you're talking about. If we're talking about investment vehicles and tokenizing those interests, or private offerings from asset managers. The current there's not going to be legislation. There shouldn't be legislation that changes anything about what we're doing in that area. There's stablecoin legislation, there's market structure legislation, but what we're dealing with is largely, very tried and true black letter securities laws that have been around for a very long time. And there are exemptions that have been utilized whether you're tokenizing or not. And so you're in a very safe space when we're talking about tokenization of private offerings of securities. And then yeah, I saw James was interested in getting the deck. James, I'm happy to send that out, or unless it's accessible through Brickhan, but
Yeah,
happy to
don't worry,
email it
James.
to you as well.
The webinar will be available for if you need to refresh these all these concepts because we have so many information. Tyler, thank you so much because it has been super useful for understanding how we can go to US now issuing a tokenization. And of course, thank you for your collaboration. And please, everyone that needs legal assistance, contact Tyler that he has all solved, almost all solved.
Thank you so much for having me. It was a pleasure.
Thank you, Tyler. Have a nice day. Hi.
Take care.
Bye. Bye.